Options trading and options are hard to understand. I get that. And they are hard to understand because most people don't know these 4 pieces of the puzzle that allow you to trade options profitably regularly that I'm about to tell you. This video will be a secret weapon for you in your options trading success. You can earn 5 to 20% a month on your money and compound it every single month. And I've been doing that on a very regular basis without fail for years now because of options. So don't throw away options, just learn these 4 things. The first piece of this is options are best when traded out of the money. And if you don't know what that means, a simple Google search will teach you about strike prices. Strike prices are how options are listed. Options are listed in either $1, $5, or $10 increments in strike price. And out of the money options are any strike price above the current stock price. If I'm trading a stock that is a $5 stock, I am looking to buy the first out of the money option. So if the stock's at $100, I'm trading the 105, and I'm always looking to buy this month, unless I'm looking to hold the option for a real long trade, which I only do during certain periods of the year like October, November, December, January. Then I'm going to buy 2 months out in time, and I never buy more than that. So buying the time really is not a benefit to you. Buying this month or the weekly options, especially with index trades, will get you into the money quicker, and out of the money options will get you into profit quicker. Why? I don't know. It's just the way it is. It's just the way it is from me trying lots of different options. When you're doing out of the money, I suggest if the stock is listed at $5 strikes, you buy a minimum of 1 strike out of the money, so 105 if the stock is at 100, or 110 stock is at 100. That's 2 strikes out. That's the most. If the stock is listed in $1 strike increments, like the QQQs are, in that case, I always buy 2 strikes out of the money. Trading the stock market in the way that you do it when you're trying to make money regularly is about really more capital preservation and watching a lot of stuff go by and looking for your right pitch than anything. Paul Tudor Jones talks about that, and he's never had a losing year in all of his trading years for years. He's just that good. Not because he is that good, but because he also waits for his pitch. That happens to be the best way to trade, and you can do that with the triple screen method. The triple screen method simply means you never trade off of just one chart. When I'm trading, I trade off of 3 charts, 4 if I'm looking for a longer trade for the trend. So a lot of my trades are between 3 and 5 days, especially during the summertime, and sometimes as much as 2 weeks during the wintertime. No more. So I'm looking to trade most of my trades off the daily, which would mean the daily would be my big piece decision chart in the triple screen trading method. So I would look for like maybe a 60-minute or a 55-minute chart as my front end action so I can see the trade setting up on the daily. I'm looking to enter it on the 60-minute chart, and then I'm following the trade through on the 60-minute and the daily in comparison, combination of both. I find that trades last longer when I don't just look at the daily, but I also look at something like a 3-day chart or just a multiple day chart time frame, with the daily fitting into that trend. And then if I'm looking to buy something for a longer period, like months, like if I'm trying to buy an option that I want to keep for 3 to 6 weeks, then I'm certainly going to look at the weekly chart that every charting service has. And I'm never going to trade against that trend using those 4 charts, minimum of 3 for the triple screen trading method. Now, the third piece of this, you're buying out of the money, you're using the triple screen trading method. The third piece of this is studying the stock option before you buy. You don't just want to buy any option. You want to find you a handful of stocks that move well. And movement well in my world is a minimum of $5 movement a week on a regular basis. At maximum, it could be huge, but a minimum of about $5 every week, up and down. You find those stocks, and you can do what's called an options montage search on your charting platform. And you can actually get, folks, options chain charts. And what they show you is how well an option moves from point A to point B. And it'll show you, does this stock have good quality options that I can trade with it? And if so, where should I buy? And you can learn that by looking at the charts. Options montage study saves me so much time, because if I want to trade options, I can see if the stock doesn't have good quality options, I'm going to throw it completely out. And I'll tell you, a really big key to this is the management of your basket of trading stocks. That is so key, because the underlying stock is what matters here, the stock movement. And then if the stock moves well, typically the option moves well. But you can find stocks that don't correlate and you throw them out. And you can get yourself down to, I trade no more than 15 stocks at a time. Really right now I'm only trading 10 at a time and a few indexes. And there's so much money to be made there. I mean, I cannot trade all the trades that are there for those stocks. And that's what you're looking for, kind of building your own basket, if you will, of stocks to trade. Now, the fourth piece of this is going to rock your world. If you're ready for this, because this is bucking the trend here. All right? Everybody talks about open interest as if it's like the thing. Open interest doesn't matter, okay? It does not matter for stocks that are above $30 a share. Stocks below, you care about open interest because you got to have enough float be there and enough people to get in and out of the option. But for stocks above $30, which is what I try to focus on trading, if it's less than 30, I just trade the stock. When you're trading options, open interest doesn't matter there. What matters is the spread. That's it. The spread between the bid and the ask. I look for a considerate amount to be no more than 25 cents on really, really big stocks. And for index trades or stocks that are smaller, 5 to 10 cents. That will help you key in on when to buy versus when to stay away. And then another thing is, if you're really looking and you don't know which option to buy, and you've already figured out, I want to buy, either this strike price or this strike price out of the money, you can go back to that options chain montage and look at the chain chart and see if the chart is going up on the option. If it is, that'll help you find an option that's getting ready to be really profitable. And those things will make you heads and tails more profitable than everybody else out there that's just trying to get rich quick and is not taking a professional attitude towards trading.